Welcome everyone to the Grand Wealth Management fourth quarter 2025 investment update. My name is Calvin Wiersma. I'm a financial advisor here, and I'm joined by Ryan Deters, who is also one of our financial advisors. Thanks for joining me, Ryan.
Glad to be here.
So we just want to take a look at some of the investment updates from the last quarter and from 2025 overall, and talk about kind of what we might expect to see in the year ahead. I'll just kind of start off with a bit of a recap on some of the returns. We had really banner year from stock markets in 2025, and bonds performed well also. In the U.S. last year, we saw just over 17% return. International markets were about 32%, emerging markets about 34%. Real estate was kind of the dog of the group, just under 4% return. But then U.S. and global bonds, 7% and then 8% respectively. So really good returns kind of no matter where you were invested. Ryan, at a high level, where does the market sit now looking back over the last year or a couple of years?
Yep. So you just went through, very strong performance in 2025 across most asset classes. And really, U.S. international markets are near at all-time highs. So there's no question that currently the market sits in a really good place, having had 3 years of strong returns. The developed market, particularly Europe, had a fantastic year in 2025. If you looked at just the Eurozone, over 40% returns, which is pretty remarkable. So very strong performance there. Bonds, as you mentioned, strong returns also in the US and globally. So we're in a very solid place there. Now, looking at valuations right now, that's where things differ a little bit, where the U.S. valuations are currently pretty high relative to historical averages, whereas globally, they're actually a little bit below where they typically would sit against the U.S. So global markets, stock markets, less overvalued than what we're seeing on the U.S. side.
And that was true even entering 2025. Which the data is pretty noisy on whether or not that is a good predictor of the next year returns, but it certainly may have been a bit of a contributing factor to why non-US stocks perform so well.
Yeah, and on the topic of valuations, people obviously want to know, what do relatively high valuations right now tell us moving forward? What do they tell us in the next year or in the next few years? And that's where historical data can be really instructive, because over the short term, they're very bad predictors. Valuation is a horrible predictor of what's the stock market going to do next year. If you look back through the last 50 or 60 years, and you look at when the market's been valued similarly to how it is right now, returns in the next year range from minus 25% to plus 45%. So it's obviously a big range, right? It's a very poor predictor. There's a really good chart that kind of illustrates how returns over that short time period can be all over the place, regardless of what the current valuation is. And if you look back, we've kind of seen that, right? Because 2 years ago already, people were saying the U.S. market's overvalued. Maybe should we be going to cash? Should we be reducing our allocation? And if you'd done that, you obviously would have missed out on really strong returns in the U.S. stock market the last 2 years. So the last 2 years have kind of illustrated that point of, over the short run, high valuations don't necessarily tell you what to expect. Now, if you zoom out over a longer 5-year period, 10-year period, you do see a much stronger relationship between high current valuations and lower future returns. And again, there's a good chart that kind of illustrates that more predictive ability over a midterm range. And so if you look out further, that's why you're seeing, if anybody reads those end of year prognostications that all of the big financial players come out with, kind of across the board, they're forecasting a bit slower growth than stock returns in the U.S. market because of where valuations currently are.
Yeah, that's a really good point. And kind of goes back to one of our foundational investment philosophies and approaches too, is that companies that have high valuations are expected to have lower returns going forward. And so integrating a systematic approach to underweighting those companies and maybe overweighting companies that have lower valuations should lead to higher returns over the long term. It hasn't necessarily played out over the last maybe 10 years or so, just because of the such good returns and valuation growth from large growth companies in the US. But the data is, over the very long term, very solid to say that companies with lower valuations often outperform those counterparts that have high valuations.
It's interesting, you wouldn't think this from the news and hearing about the Magnificent Seven and the returns there, but we've seen it play out a little bit over the last 3 years, where for 2 years there was just really strong outperformance in those 7 really large, fast-growing tech stocks. But if you actually look at 2025, NVIDIA and Google were the only 2 of the 7 that actually outperformed the S&P 500. That actually, you could take some comfort, right? For the fact that you think that it's the high-flying tech and AI stocks that are driving performance. Well, to a certain extent, yes, because NVIDIA and Google were strong contributors to the performance of the U.S. market in this past year. But even in a year where, 5 of the 7 lagged the S&P 500, you still had, I think you said 17% return for the U.S. stock market in a year like that. And so you've seen kind of a broadening of performance in the U.S. market that's now starting to kick in and drive returns for the stock market, not, just those mega cap tech stocks.
Yeah.
If we pull back from just the stock market, right, because the stock market is not the economy, that's what people always say. If we look at kind of where the overall economy is right now, how would you kind of summarize the situation, looking back on 2025 and then kind of looking ahead to next year?
Yeah, great question. If you're reading media and you're kind of looking at the world in general, everyone has a different feeling about where the economy is. But if we like to kind of look at the evidence, and when we look at some of the data, it really just is showing us that the economy is in a pretty stable spot and relatively neutral, if we can even know that there's sort of a neutral state for the economy. But unemployment is pretty low and still really well aligned with historical averages. Interest rates are pretty close to historical averages. Inflation is, although it's above the Federal Reserve's 2% target, it's pretty in line with historical averages once again. And so it's hard to know exactly where things might go. Inflation is hard to predict. Interest rates are not always, even if the Federal Reserve is lowering rates, that doesn't necessarily mean interest rates go down. And we'll see how some of the current administration's policies on immigration and tariffs impact the labor market. But right now, the U.S. is expected to continue to grow at 2% or a little above that in GDP. Other areas of the world are also predicted to kind of be at that normal growth pace of around 2%. And so even though consumer sentiment is low and there are some feelings of angst in the US economy, the overall statistics are fairly robust and don't signal a recession, don't signal particular issues arising that could really derail things.
Yeah, the way I think about it when I look at some of the charts that just show, jobs numbers, current economic data, inflation, interest rates, is it feels like we've finally kind of gotten back to normal, however you want to define that, post-COVID, where there was this 5-year period where slowly but surely, the massive numbers of job openings have now kind of come back into a truly historical average range. Maybe things have slowed a little bit too much, and we'd like to see a bit faster, job growth and hiring. But, if you look kind of across all of those and you draw bands going back 50 years, you kind of see all of them getting out of these super abnormal ranges they were in during and after COVID, and kind of back into, what we would call more normal. If you look at the long arc of history.
And interest rates too, I feel like that's always a topic, but when we're looking at a slide to look at real interest rates over the last 10, 15 years, and it's really kind of hovered between slightly positive and slightly negative, really kind of ever since 2009. And now we're kind of back into a more positive, about 1.5% positive real return or real interest rate on a 10-year U.S. Treasury bond. And yeah, to us, again, that kind of feels like, oh, this is a more normal state because there should be a positive real return for owning a bond.
Yep.
But over the last 10, 15 years, that's kind of been here and there.
Yeah. So with markets kind of, at or near all-time highs, we've talked about valuations being a little high, particularly in the US. A common concern and question we get, because, no one wants to be the one who's investing at the peak,
Right.
right before a drop, is, if I've got extra cash right now, extra income, should I be investing that? Is now the right time? How should people be thinking about investing extra cash right now?
Yeah, great question. It is always a concern about, yeah, you don't want to be investing and then all of a sudden be down 20%, right? One of the things that gives us comfort about investing, no matter where the markets are at, is that historically, when you look at rolling periods, the probability of having positive returns is above 80%, just even a year out. So in investing, that's not a very long time period, and the probability of success is still pretty high. And while there may be some ebbs and flows, and that's not going to be true in every case, we feel pretty comfortable if you are looking to invest money for the long term, no matter the short term outcome over the next 3, 6, or 12 months, you're going to have success through investing in stocks and bonds as well. And I know you've looked at some of the information on the length of bull markets, right? Because how long can we expect this to last? What are some of the things you've seen?
Yeah, so it's interesting. If you look at historical bull markets or long positive upswings in the stock market over the last 50, 60, 70 years, you would think that the last 3 years feels like an outlier, right? As we're sitting here, even knowing the history and, looking back at 2023, 2024, 2025 with, 20% plus returns in the US market for a couple of those years, 41% return in the Euro market, like you said, really good international performance over the past year, 30% plus returns there. It feels like things are going too well, and there's this other shoe that has yet to drop. And it feels like we must have run, so far ahead of economic growth with the stock markets, and that we'd be way out of line with history, right? That's just how it feels, I think, to people. And it's remarkable when you look at, there's a really good line chart that shows this kind of the 6 or 7 major bull markets or positive stock markets we've had over the last 50 to 70 years. And you can hardly find the line for the last 3 years because it's so just in the mix and aligned with kind of these historical positive periods. And so when you actually look at the data, even though it feels like we've run way far ahead, we're actually going through a pretty standard bull market cycle so far compared to historical ones. And if you look at how long these bull markets have run in the past, it depends on what time frame you're looking at, but it can be 50 months to 70 months. And, right now, we're maybe halfway through the longer of that time frame, right? We're about 3 years in. And so just looking at historical average, you'd expect, quote unquote, another maybe year to two, if you're going to have sort of an average length bull market, or even a few more years if you're going to get into the longer range of what historical bull markets have looked like. And so that's why we always want to kind of try to take the emotion out of it, right? Look at the data, look at history, and see, is there anything really extremely out of the ordinary now versus what we've seen in the past that would cause concern? And at least in terms of, how long can this go on, or, how quickly is the market growing? It's actually pretty in line with a number of historical positive market upswings.
Yeah. And it's interesting too, just to reflect on what has occurred since, beginning of 2020. I think we're always going to kind of use COVID as a demarcation marker in history and kind of forget what happened pre-COVID. But just taking a look back and thinking, what the stock markets have gone through in March of 2020 and then followed by a big run up, and then 2022 You know, a 60-40 portfolio is down 10% in 2022,
Mm-hmm.
right? And then 3 years since then. And it's just kind of remarkable to think sometimes those sudden down events can kind of just fade away.
Mm-hmm.
After, you know, getting a few years away from that and seeing how just bull markets can kind of take over and make up for those events.
And it's a consistent dynamic you see where the down market cycles are much shorter, right?
Yeah.
Typically 6 to 18 months. There have been longer ones for sure, but that's kind of the average, length of these down markets before you've recovered back to where markets were at the start of a bear market or a down market. So it's just a natural dynamic historically that these bull markets tend to be, 4 or 5 times longer than these bear markets. But the bear markets, the down markets can be very sudden, right? And so they feel like periods of a lot of volatility. They feel really bad because things are happening quickly. And then there tend to be these sometimes dramatic and quick recoveries, but sometimes just kind of long periods of really just positive growth, positive returns.
Yeah. And, that just kind of coming back to the question about what to do with cash, right? It just all speaks to you have to have a time horizon that allows you to be able to invest regardless of what happens next, right? And so having a time horizon of investing money for more than 12 months is probably a good rule of thumb. If you think you'll need the money for something specific before then, probably not a good idea to put it in the stock market. But if you know this is long-term money that you can put to work for future goals, definitely investing in stocks and bonds is going to create a better outcome than just holding cash.
And I know it's a boring mantra, but diversification, right?
Yeah.
That increases the odds over any of those time horizons that you're going to have a positive return, whether it's over a year, 3, 5, 10 years. Yeah. We would always advocate for diversification among stocks, but also with bonds, right? And so if you look at a typical 60-40 type of portfolio, that's where you see there's a better probability of positive returns over those shorter time horizons, in particular with diversification.
Yeah, great point.
So we've talked about the year past, kind of where we see the economy, kind of coming year. The natural question is, are we evaluating any changes or recommending changes to overall investment approach right now?
Yeah, good question. And the answer is no. We feel very confident about our investment approach. And the reason for that is because we feel it's well diversified. It incorporates the broad market, and it systematically incorporates this process to underweight some of these overvalued areas of the markets and overweight some of the areas that are undervalued and could provide, should provide better returns going forward. Even though the U.S. is at all-time highs, again, knowing that we have good diversification in U.S. investments, we feel well positioned there. International and emerging markets, they've had a really good year over the past 12 months. But there's probably still room for those markets to have nice returns just because valuations are currently at about average. We also see that the US dollar is probably going to continue to weaken throughout 2026, just as interest rates in the US get closer and more aligned with interest rates outside of the US. And when that happens, when the dollar weakens, that's usually a tailwind for non-US investments. So really kind of all this speaks to remaining diversified. We also kind of look at what are the global market capitalization weights, and the US market right now makes up about 60 to 65% of the global market. International makes up about 20 to 25, and emerging is kind of around that 10% mark. And so we like to stay pretty evenly weighted, and we don't want to necessarily be chasing the economy or the region that has done the best over the past year and move into an area that may not see that return going forward. So we like to kind of keep those weights pretty even on a year-to-year basis.
And that worked out, from a international versus U.S. market really well to maintain kind of those market weightings. coming into 2025, and then seeing that outperformance kick in and kind of move things a bit back towards average, valuation for international stocks relative to U.S. But like you said, still room to run there because international still, looking at his history, are pretty well below the average discount that they trade at relative to U.S. stocks. So like you said, still some room there. And then in terms of small and large cap stocks, are there things that we observe there in the coming year?
Yeah, small cap stocks really have not done quite as well as large cap stocks. And, part of that is due to, your kind of magnificent seven driving large cap returns. But kind of in the second half of last year, small caps did kind of caught back up a bit and had a nice resurgence. And part of that is due to just lower interest rates. And so hopefully that trend continues. We still see investors be compensated for taking more risk by investing in small cap stocks. One of the ways that we try and make sure that you're in the right small cap stocks is using managers that systematically filter out small cap companies that have low profitability, which is an indicator of likely poor returns, and companies that have high reinvestment rates. So they're issuing a lot of bonds or issuing a lot of stock to invest money back into their business, but not necessarily realizing the profits yet. And so kind of focusing on that small company that's highly profitable that might have lower than merited valuation is kind of that area that we really emphasize in portfolios. And over the very long term has done extremely well compared to large caps and compared to other small caps. And so we like to keep that as part of our portfolios. Mm-hmm. The other thing that I'll just mention for the upcoming year is bonds are still positioned to do well. Interest rates are kind of between 4 and 4.5%. For most bonds, we don't see a real reason to be taking much more duration risk and incorporating more long-term bonds because interest rates probably don't have much more room to fall on the long end. Mm-hmm. And if rates go up, then we would end up having returns suffer. Mm-hmm. And then sort of in that kind of short and intermediate area, interest rates may come down a little bit, but probably not a whole lot. And so I think it kind of stands to say that investors would be well positioned to kind of just maintain sort of an intermediate duration bond portfolio. And they should expect about a 4 to 5% return, unless interest rates were to change dramatically over the next year.
Yep.
Anything else that you have on your mind for the upcoming year in markets?
I'll give a PSA on the tax planning side. So I feel like we did some great work with, people that we work with over the past year, looking ahead to some of the Big Beautiful Bill Act changes and how that would impact things, particularly, leading to more people itemizing than in past years because of the change to the SALT cap. And also a lot of looking at kind of some shifting in treatment for charitable giving and how big of a deduction that you can take there, and especially for people with really high income. Mm-hmm. And so we worked, people to maybe get some of those in before the end of the year, and to kind of map that out, look at some of the differences between giving appreciated stock with something like a donor advised fund or making charitable gifts directly from IRAs. Mm-hmm. Where you're not going to be as impacted with those IRA charitable gifts by the changes there. So just, looking ahead to 2026, we'll continue to kind of monitor what those changes mean for clients, particularly with the itemizing versus standard deduction, and any other changes that might come in 2026. We're always kind of keeping an eye on the tax side of things. I think clients know, CPAs, people we work with know that we have a hyper focus on taxes, tax savings, and after tax returns rather than just, what's that gross return number for a client. And I think we continue to feel like tax planning and saving people on taxes is an area where we can add a lot of return, even if it doesn't show up on a performance report, right? It shows up on, what do people have in the bottom line net of taxes.
Yeah.
So that's something we're going to continue to be working on in 2026. And obviously, tax loss harvesting, big part of that, right? And so if we do see some volatility in 2026, we'll obviously be there every day to see if there's anything we can do to harvest some losses for clients and pass on some tax savings that way.
I think some of the topics that we touched on today, just kind of reinforce again that long-term approach of being consistent with your portfolio strategy, not making knee-jerk reactions, and just kind of turning a blind eye to kind of the current noise that we see every day in the news and even if we're watching the markets.
Yep. Well, thank you for joining us, Calvin. It was great to have this conversation with you about, markets, the economy, and kind of what we see coming in the next year. Obviously, feel free to reach out to us anytime with questions. We're here to help. Hopefully you found this informative. As Calvin said, try to tune out the noise and just kind of focus on the facts, focus on the data. That's what we're always trying to do. And hopefully some of the perspective we're able to bring here today. Thanks, and have a great 2026.